The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Economic angst derails a three-day rebound in U.S. equities. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele, just deteriorating as we get closer and closer to the close. It looks pretty ugly out there. The S&P is now down. Lows of the session down 1.4%. Tech, the biggest sell-off of the day. It's really the Mag 7 where it's concentrated, and the AI developers and infrastructure plays. VIX moves higher. Dollar, nice bid here. We're seeing the biggest move for the dollar since the end of February, Romaine.
I was trying to look at sort of that one thing that ties us all together, but there are so many catalysts out there working against markets today. Tariff risk, economic risk, budget risk, liquidity risk. Worries over it all creating a headache for investors who are increasingly finding it that there is nowhere to hide. The Mag 7 getting hammered today. The Nasdaq 100 actually back in correction territory. The S&P 500 now back below its 200-day moving average. Not helping matters is what Alex just referenced, a din of reports that multi-billion-dollar AI build-out may have been overdone. Yesterday, it was the Alibaba chairman saying the pace was outstripping demand for AI services. Today, it's analysts at TD Cowen saying Microsoft has walked away from some of its data center projects because of oversupply. NVIDIA right now, the biggest drag on the market, and the vast cohort of AI infrastructure stocks down. Dell down for a second straight day, Supermicro down for a third, and AES in the energy space falling for a fourth. All this, of course, coming against the backdrop of fresh economic data showing orders for business equipment. That's a key calculation for GDP. Well, that fell last month for the first time since October, and a separate report on the consumer from Cox Automotive that showed car repossessions are now at levels last seen in 2009. And that's not survey data, folks.
And that's also...
We see a much more sort of broader-based slowdown among all the soft and the survey data. Look at consumer expectations, consumer sentiment on labor market conditions, clearly looking for negative payrolls there. But I do fear that we've seen too much damage, and especially too much broad-based damage in the survey and the soft data in order to just dismiss it as a one-off.
And that was Max Kettner, Alex, over at HSBC. Remember, HSBC just the other day downgraded their outlook for the S&P 500.
Yep, and we're seeing it kind of play out when we take a look at the potential quarter that we're looking for the S&P and the Nasdaq 100. So the top is the S&P, the bottom is the Nasdaq 100. So think of it as just those really big tech names. And we're looking at potentially the first quarterly loss for the S&P that we haven't seen since September of 2023. Same thing for the Nasdaq 100. It's small, but it's meaningful. And you can guess what's kind of driving it all lower. It's tech, it's consumer discretionary. So it's going to be the names like Tesla and Amazon, that discretionary space. On the upside, though, it's the safety cyclical plays. You got a little bit of healthcare and financials, and then you also have energy for the quarter a little bit higher. But Romaine, it's really hard to get away from the drag of big tech.
Absolutely. Anastasia Amoroso joining us right now, kicking us off to the close, managing director and chief investment strategist at ICapital, and I believe joining us from the ICapital conference going on out there, I believe out there in Phoenix, Arizona. Anastasia, great to have you. Before we get to what's going on down on the ground at your conference, I want to talk about the broader market and whether there is an actual place to hide, because we've seen a lot of rotation in this market as people sort of fall, one sector falls out of favor, but folks find another sector that maybe does offer some profitability in life. Is that there?
I do think, Romaine, there are a couple of places to hide in the interim, which is utilities, which are other sectors that are sensitive to the fall in interest rates. And so, for example, real estate has been a better place to be, and financials also fared well. So I think there's a few of those sectors. But I will say, if we continue to have this never-ending tariff rhetoric, it is going to start weighing even more so on the manufacturing activity. It's going to weigh more on sentiment, and you might not actually find that absolute return place to hide in the equity market. So this is why a lot of the investors that we're talking to here on the ground are thinking about private markets and are thinking about how can they generate income through things like private credit that can potentially help them ride out this uncertainty in equity markets.
I mean, what's your general view, though, of economic conditions? And we should just point out to our viewers on the tariff front, we are expecting another announcement from the President of the United States today at 4 p.m. Washington time on automotive tariffs. And there's been a lot of talk, Anastasia, about the potential economic impact of these tariffs as well as other economic policies, quite frankly, that not only affect public markets, but I would think they would affect private ones, too.
They do. Here's a kind of a twofold take on tariffs. On the one hand, I do think they're a one-off. And in a way, if we get the final announcements, if we actually have the certainty of what the tariffs are going to be, that the markets can deal with that. They can price it in and they can move on. But the thing that I'm still concerned about, and which is why we're not stepping into cyclical areas, is that this is probably not a one-month endeavor. This may continue for some time. And as long as it does, it's going to continue to put pressures on the cyclical part of the market. I mean, Romaine, take 2018, for example. It wasn't a week or a month or a quarter, but it was pretty much the entirety of 2018 where we had to grapple with some of those tariff headlines. And it really wasn't until the Fed hinted at really easing monetary policy, it wasn't until then that the markets found solid footing. So I think that's kind of the backdrop that investors have to seriously consider.
And on the flip side, in 2018, we had already had the tax cut. So there was also a little bit of sugar before the sour, if you can say that. If we get tax cuts sooner rather than later now, does that calm everything down?
Well, I think it does. And maybe that is the playbook. Maybe you tackle the hard stuff, which is the tariff stuff up front in the first half of the year. But at some point, as we progress towards the back half of the year, policymakers will have to address taxes because they do expire the tail end of 2025. So, maybe that's going to be the handoff and the pivot. So, Alex, with all of that said, I do still think that you use this volatility in the equity markets, which we expect in the first half of the year, to add to some of the favorite ideas. But right now, I would not be stepping into things like semiconductors, for example, because they're highly cyclical. They could get caught up in trade wars and export controls. And we've seen that front and center in 2018. So I'm cautious on that particular segment.
Well, that's a good call because today in particular, semis are getting hit really hard in part because of NVIDIA. And we got that TD Cowen note about AI infrastructure plays, and they're kind of rolling over as well. Did you like that space? How do you play that space now? Because that was the safe haven like 8 months ago.
Right. So first of all, artificial intelligence theme has certainly not gone away. And I do think it is broadened actually with the advent of DeepSeek. And, the reason I say that, it's not just about training the models, but applying them in more and more settings. But what has changed for investors is how do you actually access the artificial intelligence theme? And let's be clear about this. For the last couple of years, we have been building out the infrastructure part of it. We have been building out, the hardware part of it. But now I think the handoff is to the AI software names. And I particularly like that space because if the training costs are cheaper, then the product rollout can actually potentially occur faster for some of those AI software names. By the way, the margins are quite significant in some of these software companies, and they are more domestic in nature. So, the pivot from AI semiconductors to AI software actually makes a lot of sense to me, given the trade uncertainty that we have also.
Well, I'm curious, though, when we talk about investors, Anastasia, that are looking for exposure to some of those names, a lot, of course, still in the private sector. There's a story on the Bloomberg terminal today that actually involves your company, ICapital. It's more about BlackRock and their model portfolios. But overall, it's this general idea of giving investors, retail investors, individual investors, more access to these products. I am curious, though, as to whether these investments offer a better degree of transparency than maybe what we saw in the past with investments in the private capital space.
Well, I think they do. And part of that is all the technology and education that has gone into making alternative investments more transparent. But part of it is also the structure of it as well. And there's still a fair bit of interest in the traditional drawdown capital call type of private market funds. But increasingly, the appetite that we see from investors are for registered vehicles, for evergreen type funds that give you a liquidity valve. It's not a full one. It's called a semi-liquid product. But at the same time, investors do have an opportunity for, let's say, a quarterly redemption up to a certain limit. So I think because of the advent of some of those products, investors have been a lot more open to it. And you're absolutely right, Romaine, that we're very excited about the unified management account and really the ability to blend in a portfolio both the public markets and the private markets. And it's interesting, many investors talk about, going beyond the 60-40, that's great, but I actually think within the 60-40, we just have to maybe redefine a little bit, what does the 60 look like? And it could be a combination of public and private market equities, and the 40 can actually be a combination of public and private fixed income. But we actually think 50, 30, 20 is probably closer to the allocation that investors should consider.
Anastasia, always a pleasure. Anastasia Amoroso, Managing Director and Chief Investment Strategist at ICapital, kicking us off to the close here on this Wednesday afternoon. A big focus today on tariffs and the potential impact on the U.S. economy. A conversation up ahead with JPMorgan Asset Management Chief U.S. Economist Michael Feroli.
All right. Plus, with all the market uncertainty in part due to tariffs, many investors are looking to alternative assets, including entertainment. We're going to talk to one of the biggest players in the space, Sherries Clarke Soares, founder and CEO at Habourview Equity Partners.
And from the entertainment economy to, well, the pet economy. Chewy results came out this morning. Petco results set to hit the wire after the bell. We're going to break down how your pet is faring with Charlie Wickers, Chief Financial Officer of Rover. All that and more coming up in just a bit, right here on The Close. This is Bloomberg.
I've been at the Fed for 10 years, and this is the most dramatic shift in confidence that I can recall, except for when COVID hit in March of 2020. A lot of it is uncertainty around the tariffs.
That was Minneapolis Fed President Neel Kashkari on how tariffs are causing a dramatic shift in consumer confidence. And St. Louis Fed President Alberto Musalem also spoke about tariffs today, warning it is not clear if their impact will be temporary. Here with what all this means for the Federal Reserve's rate path in the U.S. economy is Mike Feroli, chief economist over at JPMorgan. Okay, so are we in a vibe session? Maybe. Does that lead to a recession?
So far, as you mentioned, all we're seeing right now is consumer and business confidence, I would add, really fall off the cliff over the past month or two. The data, even this morning, continue to look pretty good, but obviously some of that relates to February, which, given the speed of events, is already pretty stale. So we do think what we're seeing in terms of sentiment will translate into softer activity as we go out this year. And we actually recently lowered our estimate for the full year growth based in part on what we're seeing in tariffs. What that means not only for sentiment, but actual for retaliatory actions by trading partners, as well as higher consumer prices and that weighing on consumers' real purchasing power.
Now, add in the extra layer of uncertainty with tax cuts, which actually could be a positive then for growth. Yeah. How are you factoring that in right now?
So we're seeing most of the action on taxes being an extension of the Trump tax cuts at the end of the year, which doesn't really change most people's personal tax rates, right? Unless you were expecting a tax increase, it probably won't have a big effect on behavior. Now, there is some possibility in the House budget resolution, a little bit of space given for something beyond just extending the tax cuts. So we could see a little bit in terms of lower taxes next year, but I don't think it's going to be a big game changer in terms of overall fiscal thrust and its ability to offset the drag that we're expecting from tariff policy.
I am curious, though, as to whether action is needed. There's been a lot of discussion about what Jay Powell said last week, whether it was appropriate or whether he's, just kind of had his head in the clouds. And I understand the Fed's idea, right? The idea is you kind of have to wait to actually see the effect before you can really react to it. At least that's what they believe.
Right.
Is there a case, though, to be made for a more proactive Fed if they do start to see an economy or the potential for an economy deteriorating?
Well, so you could say proactive with respect to a deteriorating economy or proactive with respect to higher inflation, right? And I think that's the challenge here is that the shock we're experiencing pulls in both directions of their mandate, higher inflation and lower growth. And I think that has them frozen right now, even if you had some clarity on where trade policy was actually going.
Yeah, and that's the stagflationary scenario that a lot of people have been talking about. I don't want to get too personal, but when he talked about the potential of this inflation being transitory, a lot of people said we've heard this before and you were wrong, or at least not 100% right. Why should I believe them now?
So, first of all, you shouldn't necessarily believe them. I don't think even Jay Powell believes that, wholeheartedly. I think one of the differences between now and 21 and 22 is that the labor market isn't as superheated as it was then, right? So in that very, very tight labor market, it was possible for workers to demand higher wages in response to those higher prices. That created somewhat of a self-fulfilling wage price spiral. Now the labor market is not soft, but it is softer. And if some of the growth risks, which you're just mentioned, are realized, then I think we could be looking at even a softer labor market. And so if the wage inflation doesn't follow the price inflation, then I think it would be transitory. But that's a big if, of course.
And how long does that wind up taking? Because the idea is, of course, if you have a tariff, that's a one-off shock. That's when it is transitory. Sure. But if it's trade war, that becomes more permanent.
Right.
So say we are in a trade war, when would we see that reflected in wages that would then impact what the Fed does?
Yeah, I mean,
you're laughing at me. That's never a good sign.
No, I'm laughing just, I think, because we're all dealing with the same, grappling with the same uncertainties here, which is we could be, we're going to get news 4 o'clock today. We're going to get news next Tuesday, April 2nd. And then we're probably going to get a lot of waves of news after that. And so if we say a tariff is a one-time price increase, but if you have a whole bunch of tariff increases, a whole bunch of one-time price increases is pretty much inflation, right? So even if we don't see some of the self-fulfilling dynamics in wages, I think you have problems there.
But on that last point about getting past April 2nd, we had Julian Emanuel or Evercore. He seems to think that could be kind of the peak of uncertainty, at least from a market's perspective. As an economist, I mean, you were in your seat more or less during the first Trump administration. Does this feel different? I'm talking about the way that policies are being rolled out, because it's not so much that the market disagrees with the policies so much. I think there does seem to be some concern that is not really putting out in a reliable and predictable way.
Yeah, I think the two biggest differences are, one, in the first trade war, it was really focused on China.
Yeah.
This is focused on maybe every trading partner we have. And second, in the first trade war, it did seem like USTR was following, U.S. Trade Representative was following their normal procedures and investigations, and so it wasn't quite so ad hoc in terms of how policy was being implemented.
All right, Michael, we're going to leave it there. Great to have you. Mike Feroli, Chief Economist, U.S. Chief Economist over at JPMorgan Asset Management. As we continue to march towards the close here, a closer look at some of the stocks moving on the day, including Chewy. We're going to talk a lot about the pet economy today. They came out with earnings this morning. Petco earnings are out after the bell. We're going to talk to a key analyst that covers Chewy when we come back after the break. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off with Trade Desk. CFRA upgrading the ad tech company to buy from hold, a price target at 97. A bit of a, quote, enticing valuation call after a more than 50% drop in the stock from its December peak. In addition, the analyst sees the stock benefiting from an expansion of its international business. Those shares, though, getting caught up in today's downdraft, down 5%. Next up, RH, Wedbush, slashing its price target from $500 all the way down to $350. This ahead of the luxury furniture company's earnings next week. Wedbush, though, is keeping its outperform rating and says RH is still its preferred name among furniture retailers. Those shares, though, down 4% on the day. And finally, let's take a look at Chewy, because it's bucking the trend. Raymond James maintaining its market perform rating on the stock after the pet products retailer reported fourth quarter results earlier today. The quarterly net sales beat expectations. The CEO saying customer growth and momentum remains strong. The shares getting a modest boost on the day, but given the broader downdraft in the market, 0.4% is certainly something I think investors will take. Those are our top calls, and pleased to say the analyst behind that last call joins us right now. Rick Patel, Equity Research Analyst and Managing Director at Raymond James. And Rick, the numbers look good. I am curious about the longer term outlook. You still see this as a growth company?
Yeah, thanks for having me. And yes, we do think it continues to grow here. So as we think about sort of the momentum behind them, you have to keep in mind that the pet market was under pressure for the last couple of years. You had an uptick in pet relinquishments, and pet adoptions were weak in that post-COVID period. But things started to change for Chewy in the middle of 2024, where they saw a positive inflection in active customer growth as those market conditions improved. And as we think about 2025, we do think they're going to continue to benefit from the ongoing active customer growth as market conditions for the pet household formation area normalize, as well as self-help drivers as the company's net sales per active customers continue to go up as they have been for quite some time.
How much pricing power does the company have in your view?
It's not about pricing. I think it's much more about market share gain. So when we think about what's embedded in expectations over the next year, I think inflation is planned to be flat as far as where guidance goes. We'll see where the industry goes in terms of handling their tariffs, but we're not assuming a whole lot on the pricing front. I think most of the growth is going to come from market share gains. You have an uptick in consumers shifting towards the digital channel for e-commerce in the pet category. That's something that really started to pick up steam in the back half of last year, and I think that'll continue. And then you have market share gains where, when you think about the pet category, it's basically Chewy, Amazon, Walmart, and then everyone else. And I think Chewy has been benefiting a lot from everyone else, where there's still market share up for grabs.
Bloomberg Intelligence, our analyst folks here, said that revenue could reach as close to $14 billion by fiscal 2026. Is that in line with what you guys see?
Yeah, we haven't published our official numbers yet, so stay tuned on that. But what I would say is that, we expect a continuation of revenue growth, and the company put out guidance over the next year to be up in the 5% ballpark. And, that includes lapping an extra week from the prior year. And it does seem like a reasonable path going forward as well.
Their active user growth, though, has been somewhat muted. How do they beef that up a little bit?
Yeah, it has to do with the spread between pet adoptions and pet relinquishment. So, post-COVID, people were abandoning their pets. It was a bad situation for the industry. But that started to improve in the middle of last year, where you had pet adoptions beginning to outpace the relinquishments. And we're seeing a continuation of that momentum. So when you think about the pet category overall, we're seeing low single-digit rate of growth in active customers that is in line with where the pre-COVID trend was. So it looks like industry conditions are normalizing, and Chewy's benefiting from that as one of the biggest players.
I am curious, though. I mean, there's been a lot of talk about economic conditions, whether we're headed towards stagflation, even recession here. There's always been this narrative that pet products are kind of recession-proof, right? I mean, I have a dog, and I'm not going to change my spending habits on her. At least she won't let me, Rick. So I am curious as to whether investors can take some sort of comfort in that, or is that the wrong way of looking at it?
No, I think it's a great point. And when you think about Chewy, you have to consider that 80% of their revenue is auto ship products. So think about someone coming into the platform as a new pet owner. The company usually onboards them as a consumables customer, someone that's buying food. And then they join the ecosystem. They start buying hard goods, things like dog toys and healthcare products down the road. But it's really that consumables piece that I think is the most sticky at being north of 80% of the business. So when you think about a recessionary scenario, we agree with you that I think consumers are likely to, view their pets as members of the family. And I think it's a defensive part of the business.
And I like the fact you point out, Romain, they won't let you change the food. Very different. All right, Rick, thanks a lot. Rick Patel, Managing Director and Equity Research Analyst over at Raymond James. And that's why the stock is up 120% just in the last year. All right, coming up next, we're going to speak to Sherries Clarke Soares, the founder and CEO of Habourview Equity Partners, about where she's finding alternative investment opportunities in this environment. This is The Close.
.30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostick.
And I'm Alex Steele, taking a look at the markets, continuing around the lows of the session. But just to say, it is just tech, because the equal weighted index is pretty much flat. Okay, so you're doing your half glass full thing once again here. A teeny tiny bit. All right, I'll give you that much. But I mean, look, it's important, though, when we start to see this sell-off once again resume in tech, because that is the biggest weighting. And it does raise a lot of questions as to then what becomes of the broader market rally and whether you go searching elsewhere for yield, for return. Exactly. Yeah. I mean, the Dow transports, they're up. I'm just putting that out there. That's like not glass half trucks full. The trucks. Anyway, speaking of the market, we recently spoke to Mark Lassery, the chairman and CEO of Avenue Capital, about where the best opportunity is, and we asked him if he finds better value in sports versus other areas of the private market.
I think in our core business, we're able to make about 10-15% a year, because really what we're doing is lending money. I think in sports, especially in sort of emerging leagues, you can make multiples of that. You can make sort of 10, 20 times your money. And I think in sort of the big four, over 20 years, the IRR of that's been about 11%. So if I think over the course of the next 10 years, I'm still going to make 10, 15 in sort of the big four, I would do that.
Well, Well, joining us now from more is Sherries Clarke Soares, founder and CEO of Habourview Equity Partners. Great to see you. Thank you for coming in.
Oh my goodness, thank you guys for having me.
So where's your favorite opportunity right now?
Yeah, I mean, listen, we are very big fans of all things media and entertainment, and particularly long-dated content. You may have heard or seen me say things like content is queen. We believe that. Content, as we heard from Mark Lazary, focus on sports, we believe it's truly non-correlated. It's obviously non-discretionary, as we're seeing inflationary pressures around the globe, but certainly here at home. It's not actually impacted any of the assets that we own. So we love things in the content space, particularly in the music, particularly in content that is specific and nuanced. Those are things that we think are winning content opportunities.
When we take a look, say you mentioned the environment and inflation, et cetera, how do you produce content cheaper? Because prices are going to go up, right? You can't produce like the bazillion-dollar episodes anymore, right?
Yeah, bazillion-dollar episodes are, I think quickly a thing of the past. We're really focused on partnering with creators, creating an ecosystem where creators and our capital come together to partner around how we think about creating content and content ownership for the long duration. The other places that you're seeing things that are, again, more specific, more nuanced, more irreverent. I think irreverent is the topic of the moment. It is the content that becomes irreplaceable and iconic. People like Alex Cooper or Kai Cenat or Mr. Beats or, Bad Bunny or Lady Gaga or Doce or Kendrick Lamar. All of these are massive global moments, but they're actually really nuanced and really specific content, talking to very specific audiences. And as you do that, you can find partnerships with people that, are creating content and investing in content for very attractive risk-adjusted returns. We've been able to identify an opportunity in this marketplace to deliver returns well above what people are seeing typically in the private markets with yield, I'd also offer up, kind of in the private equity style returns with kind of yield and downside risk protected. So that is what we do every single day. But the way to do that is to really be thinking about against this nuanced idea. We just do it differently than others, but we do believe in these themes around IP.
And you've struck some interesting deals lately. And we should point out you have a background in Wall Street. You spent a lot of time at Morgan Stanley before you're kind of branching out on your own. You struck a deal with KKR to help kind of fund some of your investments. You have a deal that I just read about that maybe you want to talk about to create film content, and that includes some biopics involving some relatively prominent people. Yeah,
absolutely. I mean, look, one of the things that we're seeing and finding very attractive in our markets is that high quality pools of capital are really attracted to our asset classes. A lot of it is who we are as a platform. There's obviously the macro themes as we talked about. Who we are as a platform is really focused on being very data driven. One of the investors we were talking to recently was like, oh, you guys are the Moneyball of music investing and of content investing. And I love that actually so much. And we are. But just like, if you were Moneyball and you basically only use data to identify who the players are and you just put them on the field, you're not going to win the World Series that way. So you still got to coach the game. Yeah. So for us, coaching the game is really about partnering around iconic pieces of IP to drive and build an ecosystem so that we can drive value to all of our IP after we've done a little bit of this Moneyball around how we figure out where to invest.
With regards to that data-driven approach, though, too, I mean, you came to on a lot of people's radars when your company was buying up music catalogs. Yeah. So basically IP that already existed. You're kind of going into film content. There's a longer runway from that. Like you strike a deal, you got a film, edit this stuff, market it. It could be a year or 2 years before you do that. How do you make sure that the data you use at, say, day one is going to be the same, 365 days later?
Yeah, absolutely. I mean, I think for us, it's very much so focused on, again, using data to identify where our audience is, what are they thinking about, what do they care about, how do you drive outsized returns around that, and also thinking about how you create partnerships to drive outcomes in a faster and more efficient way. One of the things, to your point about how do you create things more cost efficiently, is you really have to be thinking about A, partnerships, but B, also speed to market. And again, like I said, some of these sort of content creators that we see that are winning are creating content, in very kind of quick bursts. And so thinking about how to be able to leverage moments like that. But then also, again, it's a portfolio approach. Our portfolio across all of our titles are very well seasoned. We have an average age of 12 to 13 years old in our portfolio. So things that have been released almost over a decade ago. So it allows us for rooms to be thinking about creating alpha generating opportunities on the front end.
Are you now in the market for additional music properties?
We're always in the market for additional music properties.
I saw the former company you ran is potentially shopping around Tempo.
I think they sold, actually, to Warner Music, who's a great partner of ours.
Did you have any interest in bidding for it?
I'm always interested in bidding for any attractive catalog at an attractive price to the extent I can deliver returns for my investors.
What about Suicide Boys?
You know, I love every single opportunity.
You're not going to bite on them.
Listen, but interesting that you mentioned something like that is that one of the things that is beautiful about our catalog, which is also beautiful about how we think about investing, is that we are agnostic from an investment thesis perspective to any genre. Okay, so we really just care about what audience it is. We have no opinion on what the voice of the artist should be, what they say, what they care about. We're really focused on really driving behind audiences, and there's some great audiences out there around all kinds of nuanced music, from heavy metal to R&B and hip hop to classics like Fleetwood Mac and Pat Benatar, and to Spanish language music like Bad Bunny and Esteban Armado. These are the things that we invest behind.
Before I let you go, what about valuations? Like there is so much more money in this space. What's that looking like?
Yeah, listen, I mean, I think when you have a differentiated way to invest, you can always identify value. We are value investors. We want to make sure that we're paying the right value to our creators for the work that they and the time and the effort that they put in. But we're also in the business of delivering high quality returns to our investors. So the market is fragmented enough that if you continue to follow the way that we think about investing, we've been able to identify ways to identify value in a really rich way.
All right, Sherries, always a great conversation. Thanks for being here.
So kind of you to have me. Thank you very much. Have a great afternoon.
Sherries Clarke Soares, founder and CEO over at Habourview Equity Partners. When we come back to the public markets and back to, well, a big catalyst for the downdraft today here. An interesting report about Microsoft and data centers, a big drag on AI infrastructure stocks. That's coming up next in our Stock of the Hour, right here on The Close on Bloomberg. Shares of NVIDIA leading the entire market down, including the AI infrastructure sector. This apparently on the back of some news that we learned from analysts over at TD Cowen, who said that Microsoft is apparently walking away from some of its new data center projects in the U.S. and Europe, attributing the pullback to an oversupply in the clusters of computers that power AI. Jess Menton helps lead our stocks coverage here at Bloomberg, joins us right now. This kind of a 1-2 punch, because it seemed like about 24 hours earlier, we heard from Joe Tsai, the chairman over at Alibaba, who kind of said something similar, not quite as forceful, but the idea that maybe we went a little too far, too fast.
And especially because, to his point, the concern that maybe some of these companies were spending too much with this. And when it comes to Microsoft, the news by Cowen putting out by those analysts today, I mean, the company for Microsoft still expects to spend about $80 billion through their fiscal year through June when it comes to AI type spending in those data center businesses. But they did caution that some of that spending and the pace of it might begin to pull back over the coming year after that. So you are seeing, though, even though the contracts that it was pulling back from in Europe, you are seeing some of its rivals, whether it's Google or Meta, try to step in and still compete in that type of space.
And here's my question, too, with that. I don't think we have the answer to it yet, but are they just sort of pulling back because they want other companies to rent their space out so Microsoft doesn't have to build it? And in the meantime, Microsoft then gets to profit off of the inference part, which is where they make their money.
Right. And then the OpenAI ties to Microsoft.
Wait, what? Was that surprising? Clearly, you don't listen to me on radio, okay?
It's a theory.
House is on fire.
Because we're talking about the LLMs, right? And trading it for LLMs versus the inference, which is like if you and I look on our phones and like ChatGPT talks to us, Microsoft still gets money from that part.
Exactly, and especially because the way that some of these companies are doing this, because you still have, especially if you're thinking about NVIDIA's top customers and the type of AI spending tied to that. I mean, Microsoft, of course, is one of those, but so is Alphabet as well as Amazon, and Meta too. So you still are seeing these companies try to step up here, but even beyond the data center businesses and infrastructure type companies, like you're starting to see a lot of those data center, especially actually one that was important today was Vertiv Holdings. Yeah. So that stock's down 12%, on pace for its worst day since actually January 27th. And so what happened here, actually, Cowen analysts as well as Barclays were warning that they face near-term challenges in a sluggish buying data center equipment, potentially hurting that demand for its cooling systems. So you're seeing this beyond kind of the big poster child type names for data center businesses that are working with those, and obviously these two, because those are key components performance that a lot of these companies are working with.
So Vistra was down, Ericsson Networks, and of course a lot of the power companies as
Constellation
well.
Energy
Constellation
too. I know that's
Energy.
something that Alex watches pretty
Yeah.
closely with, and that's down about 4.5% right now, on pace for its worst day since March 10th.
I do want to ask you just about broader market conditions, and particularly this idea of liquidity, or maybe the lack thereof. And you had a great column on the Bloomberg Terminal that cited data, I believe, from Deutsche Bank.
That's right.
That basically says that the liquidity just isn't there, and maybe that's why we're seeing these types of swings in the market.
And a lot of that had to do with just the extreme positioning coming into this year. And the thing with liquidity isn't necessarily something new. We saw that after the global financial crisis in 2008, just because of the restriction on banks and some of this going into the options type space and things like that in clearinghouses. But specifically this year, when you're seeing some of these tariff type concerns, you're seeing more single stock volatility. So even if you see the VIX down below 20 again after it got close intraday to 30 earlier this month, you're still seeing pockets of volatility in single name type stocks. And so you're starting to see it harder for a lot of traders I was talking to at prop firms trying to execute those trades beyond the top 10 names or the big tech and Mag 7 names that are more liquid, and especially maybe some of these micro cap type names and small cap type stocks as well.
It was a good column. Definitely check it out. It's a must read. Jess, thanks so much. Bloomberg's Jess Menton joining us there. Just a quick check in here on where we stand, Romain. We're still looking at the S&P down 1.2%, Nasdaq over 2%. We're holding around the lows.
I'm going to take your glass half full thing.
Okay.
Because you talked about transport.
Take it.
That is in the green. Avis budget up 4%. Trucking companies up a couple percentage points. Even FedEx getting a bid here on the day.
I mean, but FedEx was beaten up, right? So maybe there's a little bit of that. See, I just take it away. I
you're
give it
me.
and then I take it away. All right.
It's like Freaky Friday.
Leo Kelly on Verdence Capital joining us.
But I do still think that you use this volatility in the equity markets, which we expect in the first half of the year, to add to some of the favorite ideas. But right now, I would not be stepping into things like semiconductors, for example, because they're highly cyclical. They could get caught up in trade wars and export controls. And we've seen that front and center in 2018. So I'm cautious on that particular segment.
Anastasia Amoroso over at ICapital. She kicked us off to the close just about 50 minutes ago. Everyone right now in this market, Alex, trying to find some sort of buying opportunity, kind of hard to find on a day like today.
Definitely not in tech. Semis lower, autos lower. You got the Mag 7 lower. All the names within the Mag 7 getting hit. Tesla in particular, Nvidia getting hit really hard. I mean, the Russell's even down 1%. Equal weight is not bad, and the transportation sector is not the worst.
Yeah, not the worst here, but some of the bright spots that people have been looking to, like financials, also down on this day. We should point out we are keeping an eye on Washington. The president is expected at some point today to announce new tariffs on cars coming into the country here. We'll see what kind of effect that has on the market. And really, it's the broader question about what kind of effect is this going to have on the economy.
You have to wonder if it's not car parts, but it's the finished car. Does that make it more palatable? If you're putting together the car here in the U.S., does that make it easier? I don't know. But the whole sector there is selling off.
Yeah, but the fact you asked that question, I think, is exactly why we see the market doing what it's doing. It's that idea that no one seems to know, or no one has that answer. Maybe one person has that answer, and he's the guy in the White House, but it'd be nice if he told us, the rest of us.
What that was. And that's what Anastasia was basically
Yeah.
saying, like, we just don't want to step in and buy the dip yet.
Yeah.
Basically, if I paraphrase what she said.
Yeah, people looking for maybe just a little bit more of the contours of what this policy is going to look like so they can make those investment decisions. One guy who helps to make those decisions is Leo Kelly. He joins us right now. He's the founder and CEO over at Verdence Capital Advisors. And by the way, my favorite ex-Bloomberg employee. Leo, great to have you here on the program. You've done well since you've left. I do, in all seriousness, I do want to kind of get your take on just the contours of conditions, because we kind of focus on these day-to-day moves in the market. And a lot of it really is about this general idea that people are just having a hard time knowing where the economy is going, where policy is going. And we had Julian Emanuel from Evercore on the program yesterday, and he said, once we do have a little bit more clarity on what those policies are, whether you like them or not, that could give the market the opening to sort of move higher. Do you buy that?
I do. It depends on which market we're talking about. I think that's really what's most important here, Romain. Uncertainty is never something the market wants to see, and it's going to punish uncertainty every time. I do think it's interesting. The comment, "Hey, I wish Trump would tell us what he wants to do here." Trump not telling anybody what he wants to do is Trump, right? He is a negotiator, and he's trying to move the goalposts in favor of his agenda. And so I think there's going to be a lot of bombastic language. At the end of the day, he continues to try to navigate through and negotiate deals. I think we're probably seeing the height of uncertainty around all this. So as that starts to clarify, I think that's helpful. I think there's bigger issues. Those I think are very short-term issues. Things like inflation, things like too much money in the system. There's some overvaluation in the marketplace. Those are really the things that we're looking at, trying to invest capital more in the longer term. As you well know, we focus on that.
All right, we'll talk about some of those issues. And let's start with inflation, because that's been top of mind given the Fed meeting last week, and we have a big PCE report on Friday here. I know inflation expectations are elevated, significantly elevated, but we haven't actually seen actual inflation meaningfully increase from where it's been for the last few months here. Are you worried that we could actually see an uptick, a meaningful uptick?
I am worried. I think what gets missed here with this whole inflation argument, it's not about interest rates. It's not about more eggs being shipped into the U.S. It's really about money supply. And we've talked about this many times. There's a very interesting correlation between inflation and M2. And last year, at the end of the year, when inflation started to fall, and everybody got excited about several rate decreases, and the Fed was going to bring back a more dovish stance, M2 was falling. It actually fell about 5%. When inflation started to rally back, M2 was growing again. So at the end of the day, the challenge is we flooded the market with money, meaning the Fed increasing their balance sheet post-COVID. The federal government has been spending like crazy. Both of those things increase money supply. And until we fix that problem, inflation is just going to be stubborn. It's just going to keep coming back and keep coming back. So I think this is a longer term issue that folks are just looking for a quick outcome, and we're just not going to get one. It's a part of the landscape now.
So if it's part of the landscape here, is it part of the landscape in Europe? In some ways, Europe might welcome that, right? More M2, if, for example. And we are seeing potentially Germany pump more money into the system as well. How do you guys look at Europe?
Yeah, first of all, we actually like Europe as a place to invest money, not because of the inflation issue or the money supply. The answer first to your first question is absolutely it's an issue in Europe and everywhere else in the world. What was interesting about COVID, what creates hyperinflation is if one country just starts printing money like crazy and no one else does, then we're going to have hyperinflation, right? That's wheelbarrows of money to get a loaf of bread kind of stuff. But what happened in COVID, everybody printed money. And so the water was raised on all ships. So all ships are pricing higher. All ships are having inflation. And so we're seeing that across the board. What makes Europe attractive is valuation. So what we're seeing is 2 to even close to 3 standard deviation spreads in valuation between Europe and the U.S. large cap stock S&P 500 neighborhood. So what does that mean? At 1 standard deviation, there's value. At 2, we're talking about once in 10, 20 years. As you start to approach 3, we haven't seen anything like this since the tech bubble in 2000.
Eek. Okay, but that makes me nervous. So, so where do I want to go if I get nervous?
Well, cash is still fine. You definitely don't want to go with bonds. We still think their threat of higher interest rates is greater than lower interest rates. So I'd be cautious about going out on bonds. We're not getting paid for credit risk. So I think you're looking at cash. I think there's plenty of places in equity to find value. Small cap, mid cap. I do like the international space. We do like some of the large cap space that's not the Mag 7. So again, we still have this AI revolution coming. We still have productivity increases in front of us, uncertainty slowing down. I do think we have more volatility in front of us, but there's opportunity on the other side of all that. Also, we like the private markets. The private markets are not caught up in these massive multiple valuations that we're seeing in some of the public markets.
Yeah, we've heard that a lot on this program, and certainly today. Leo, I have to leave it there. Leo Kelly, founder and CEO over at Verdence Capital Advisors. As we get closer to those closing bells, 2.5 minutes ago, I was just taking a look at the M2 money supply he was talking about. He no lie. It's certainly been back up, which I actually was kind of shocked by.
Oh, yeah.
Not far off the record high that we had back in, I think, 2022.
Yep.
Yeah.
And then if it contracts, though, quickly, if we get fiscal contraction kind of thing, does that change the scope?
I don't know, and I don't know how you reconcile with the idea that maybe you start to see a little bit of a downdraft in rates here. We are seeing a downdraft in stocks on this Wednesday afternoon. A bit of a sell-off, and a full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you through that closing bell. It's a global simulcast. It starts now with Scarlett Fu in the TV studio, Carol Massar and Tim Stenevec in the radio booth as we welcome our audiences across our Bloomberg platforms, as well as our partnership with YouTube. Carol Massar, a little bit of a turnaround from what we saw the last 3 days where this market was trying to move higher. A big downdraft today for a wide variety of reasons.
Yeah, absolutely. I think investors were kind of hopeful over the last 3 days. But having said that, once again, I think it's tariffs. Again, the uncertainty, maybe new tariffs, different levels of tariffs. We're waiting maybe, I guess, at 4 o'clock. Supposedly some news when it comes to auto tariffs. And we've seen certainly various names in the auto space moving around on that news today.
Does seem the president is running late, so we're not going to get those comments until after 4 o'clock. But still, the auto sector getting hit as a result of uncertainty there, Scarlett.
Yeah, you look at the economic data, and on the whole, durable goods looked pretty good. It beat analyst estimates. But when you break out and just look at core capital goods, which backs out like aerospace, that unexpectedly declined. So really, it's more proof, and this time it's hard data showing that companies are holding off on their capex.
Guys, I'm also going to go to the fact that this is really still about big tech, because you look at the equal weighted index, that's pretty much flat. I appreciate that small caps are also getting hit, but it's the Mag 7 that's really dragging everything down. That's not really a tariff story. That's an AI infrastructure risk story at the end of the day.
Yeah, and that's really evidenced by the fact, not only what you said, but the equal weight only down 0.2%, but Dow Transport's up about 0.6%, as we are seeing a bid come in to, well, old school stocks, FedEx, Union Pacific, trucking companies as well. Still, we do have red across the screen for the primary indices here on this Wednesday afternoon. A Dow Jones Industrial Average is going to close lower by more than 100 points, or roughly about 0.3%. The S&P 500, the benchmark index, down more than 60 points, or about 1.1%. The Nasdaq indices each down about 2%. The composite down 2%. The Nasdaq 100 down about 1.8%. The biggest drag, of course, the Mag 7, NVIDIA, leading that whole cohort down. The Russell 2000 also getting dragged down by financials and energy stocks, down about 1% on the day.
Yeah, and having just a quick check on the S&P 500, kind of an even split, guys. 266 names in the index, gaining ground today, Scarlett, 235 to the downside.
Yeah, but because of the heavy weight of tech and tech-related companies, you're seeing that big drop in the index. You have infotech, communication services, and consumer discretionary, which basically holds all the Mag 7 names down by at least 1.5%. The sectors that are green, all the smaller sectors, consumer staples, utilities, energy, real estate investment trusts, they tend to be more defensive as well.
All right, let's get to some of the individual gainers. GameStop on that list, stock up more than 11% here at the close. This company, of course, we talked about it after the close yesterday. The meme stock frenzy that we saw back with retail traders really coming off of COVID and so on. Its company's board saying it approved a plan to add Bitcoin as a treasury reserve asset. Company did also report fourth quarter net sales that tumbled 28% year over year. Just a reminder that the fundamental business, certainly not so interesting, but nonetheless interesting for investors in today's session. Dollar Tree up more than 9% at its highs today, finishing the day with a gain of just shy of 3% in the trade. The news today, company saying it's going to sell Family Dollar, the chain, for about $1 billion to Brigade Capital Management and Salem Capital Management for a decade after buying the business. I remember when this news and the consolidation of these two big players in the sector. So that certainly coming out in today's session. And then Cintas Corporation, its number one gainer in the S&P, was top two in the Nasdaq 100. It's an $83 billion market cap company, workplace uniform provider. Did come out with its full year earnings per share guidance that beat the average analyst estimate. And so investors, maybe not an exciting company, but investors certainly found it exciting in today's session.
All right, let me just jump in because we did have results out of Petco, and the ticker is my favorite, WOOF, W-O-O-F. Fourth quarter net sales meeting analyst estimates, $1.55 billion. The consensus was for just over that amount, $1.56 billion. And in terms of other numbers, the net loss, the bottom line, was $13.8 million, wider than what was anticipated, which was $10.3 million. The stock moving a little bit higher in after hours trade by about 1.2%.
All right. Keeping an eye on that stock. I'm also keeping an eye on Stocks that moved lower in today's session, NVIDIA is the one to talk about because that just dragged everything lower, whether we're talking about the S&P 500, the Nasdaq 100, or the Nasdaq Composite. It was the biggest contributor to the downside today, down 6%. Got hit for a couple of reasons. It started the day lower after this report from the Financial Times late yesterday that said NVIDIA products could be at risk from energy efficiency rules for the use of advanced chips that would prevent Chinese companies from buying NVIDIA's processors. Then we saw shares of companies tied to AI today fall as a result of growing concern around spending for AI data centers after TD Cowen came out with another note that said Microsoft has walked away from new data center projects in the US and Europe given, quote, oversupply relative to its current demand forecast. NVIDIA down 6% today. GameStop was up. GM, General Motors, was down 3.1%. I'm watching shares of all the U.S. automakers. In fact, President Trump has been set to announce details on tariffs. That was set for 4 p.m. We'll bring you those comments as soon as we do get them. He was set to speak from the Oval Office, though. Analysts have estimated that new tariffs could add thousands of dollars to new car prices. And finally, shares of Vita Coco fell today by 11%. It's the coconut water company. This after Ningi Research issued a short report on the company. They argue that 2024 sales growth underperformed category performance, and Vita Coco's market share, quote, has been falling since early 2023. Vita Coco, for its part, out with the statement that says there are numerous inaccuracies and mischaracterizations in the short report. Vita Coco also reaffirmed its disclosure from February that it expects to lose some regions with certain private label retailers during 2025 due to inventory constraints. Shares falling today by about 11%.
All right, I'm going to go to the bonds, guys, for a second. What's so interesting is you had the sell-off in the equity market and you had a sell-off in the bond market. You would think that with the risk-off mode that you'd see a move in the dollar and in bonds to the upside, but we didn't get that. Yields higher on the back end by about 4 basis points. We did get a 5-year auction today. It was not as great as the 2-year. We get 7-year tomorrow as well. But for now, the bonds not getting that safe haven bid that maybe the dollar didn't get, guys.
All right, guys, we talk about a market where a lot of people are sort of looking for a direction or at least looking for a little bit more clarity. And I guess it raises the questions as to sort of what moves the needle next. Are we going to wait for that announcement from Trump and the tariffs? Do we wait for the next batch of economic data, or do we wait for earnings season, which quite frankly is only, about 3.5 weeks away?
Yeah, I kind of can't wait for the commentary with earnings. I hate to say I'm ready for another earnings season, but I kind of am. But I am too, yeah. Right, to kind of get some clarity of what's going on in C-suites. We keep bringing in, leaders, people who are managing money. We had a guest today that, new money put to work, and they're like, we're not going to put it anywhere. We're going to kind of keep it in cash or cash-like investments because we're just not quite sure where things are going right now, and they want things to settle down.
I think April 2nd is the next catalyst here. That's what the president calls Liberation Day. We're supposed to get more details on tariffs. Potentially we'll get more today. I think there's just been so much waiting and sitting back and saying, wait a second, okay, what are these tariffs going to look like? If you're the CFO of a company and you want to deploy money to for a CapEx project, for example, you're going to wait to see, how much copper is going to cost. How much steel and aluminum is going to cost? What's going to happen when it comes to the consumer if things get more expensive? I think there's a lot of uncertainty there, and hopefully we'll get more clarity April 2nd.
Well, the tricky part, too, is once we do get clarity, it's pretty easy for the president to remove the tariffs or change the tariffs after they've been announced. And we've seen several instances of something happening, and then a couple of days later, it's rolled back, or parts of it are rolled back as well. So that just leaves all these companies paralyzed.
That's the art of the deal, Scarlett.
That's the art of the deal. Right.
Are you familiar with it?
I think there's a book by that name.
It's negotiation.
Which is why, though, I find so interesting that the Mag 7 got hit so hard today on totally different reasons, right? Like we had the Microsoft and the TD Cowen note. You had Tesla getting a downgrade to hold. You had NVIDIA and those energy rules you were talking about, Tim, and Google. You have an analyst saying that potentially the youngsters are going to go to ChatGPT and not Google for search. Like these are individual issues that have nothing to do at the end of the day with tariffs.
Yeah, absolutely. And I think that's what's creating so much uncertainty. These are much more structural, much more long-term, and don't really have historical precedent in a lot of ways. I do want to just go back real quickly to one of the stocks that you were talking about, Tim, and that was GameStop, which had a phenomenal day today. But here's the rinse and repeat that we've seen so many times with this, a share offering, $1.3 billion in a private placement, and that now has the shares down in after-hours trade by about 7%. Why do people do this to themselves?
I don't know. Maybe because it's a Bitcoin mining company now or something?
Is that what it is?
Bitcoin? It buys Bitcoin, right? Maybe
It'll
that's
still be
why?
a proxy for Bitcoin.
I don't know. Maybe that's a thing. You do that.
I don't know what kind of company it is anymore.
Yeah.
Kind of crazy. All right, guys, that's a wrap. We'll see. Await for some more news out of the White House and potentially on those auto tariffs. That is a wrap. Our cross-platform coverage on radio, TV, YouTube, and Bloomberg Originals. I know Alex is heading out. Scarlett and Romain continuing there on Bloomberg Television, and Tim and I continuing right here on Business Week.
And a lot of the market action today wasn't just about tariffs. It was about economic conditions. We did get reports on durable goods orders, business inventories, and more importantly, also on car repossessions. There's also been a big discussion about inflation and the impact there. That conversation continues after the break. Omair Sharif, founder and president of Inflation Insights, joins us next. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romain Bostic. That rebound rally, three straight days, that is over. It came to an end in a pretty big way with the S&P 500 down more than 1% on the day. We should point out that the Nasdaq 100 index was down almost 2% on the day. It's now back down 10% from its all-time high. So that correction territory that it actually hit just a little while ago. We are keeping an eye on what's going on in Washington. We are awaiting the President of the United States to make an announcement about auto tariffs. The auto group as a group were down about 5% on the day, though it was a really wild day. Ford at one point was down a couple of percentage points, actually finished the day in the green. General Motors was down about 4%. It did finish the day in the red. We'll see whether that changes tomorrow once we get that announcement from the president. But look at the two lines on your screen here. The Mag 7, of course, really dragged the index down. And then, of course, you had that report out of TD Cowen making the case here that maybe Microsoft was scaling back a little bit on its outlook for that AI build out. Some concerns here that maybe we got a little bit too far too fast. You all saw the whole AI infrastructure cohort down on the day as a group, down by 1%. And of course, that was led by one big stock.
Yeah, that would be NVIDIA, and it's really the linchpin of the whole AI trade. NVIDIA down 6%, the worst performer among the Mag 7 names, and for two reasons. Romain mentioned the AI build-out, data center build-out note that sent the whole complex lower, but also the FT reporting that China has these new energy efficiency rules that would effectively disqualify NVIDIA's H20 chips that were, remember, specifically designed for the China market because they meet U.S. export controls. This is a $17 billion business for NVIDIA in China, and it perhaps is at risk of losing that. So that stock lower. GameStop up about 12% on the day. The video game retailer says its board approved an update to its investment policy to now add Bitcoin as a Treasury reserve asset. And after the market closed today, we learned from GameStop that it is raising funds by selling about $1.3 billion of shares privately. Romain?
The economy top of mind for a lot of folks, coming off some interesting data that we've gotten earlier this week and a big PCE report coming up on this Friday. We already know that long-term inflation expectations are already at a 30-year high. And while Jay Powell isn't quite ready to act, several Fed members have spoken about it. Chicago Fed President Austin Goolsbee talking to the Financial Times, saying that the central bank is no longer on a golden path. There's a lot of dust in the air. Those are his words. We're from St. Louis Fed President Alberto Muslim saying that it's not clear if the inflationary impact from tariffs will prove temporary. And Minneapolis Fed President Neil Kashkari saying the recent decline in confidence among consumers, a lot of that reflects uncertainty around tariffs, which in his words could be a bigger effect than the tariffs themselves. Joining us right now to kind of make some sense out of all of this is Omair Sharif. He's founder and president of Inflation Insights, which provides insights, analysis, and research into U.S. inflation data. All right, so Omair, with the asterisk here that the actual inflation data itself hasn't changed a whole lot, but we have seen expectations shift a lot here. Does that worry you?
Yeah, I think I'm not completely worried just yet. I think if you listen to what we heard today out of some of the Fed officials, it's going to be more of those long-term market inflation expectations. If those really start to break out, that's going to be a much bigger cause for concern. We have seen, as you said, consumer sentiment shift. We've seen expectations for, let's say, Michigan 5-year, 10-year inflation shift higher. But I'm not quite worried yet because we haven't really seen it in other surveys. So, for example, the New York Fed survey hasn't shown the same bump up in inflation expectations. I think, though, Fed officials are rightly concerned because we're still in an environment where price increases over the last few years are really fresh on everybody's mind, and we are now potentially getting another round of price increases coming. So I think they are right to worry about whether or not that becomes more broadly entrenched in the market and in other surveys as well.
What's the difference? Because when we talk about, kind of what Jay Powell said, and of course, a lot of jokes were made about the transitory comments, because, we were here before, and you told us it was transitory, and maybe it wasn't. But draw a distinction between what's different about the inflation situation or the inflation outlook now and what's driving it versus what we saw a few years back coming out of the pandemic.
Yeah, so I think, the first thing is obviously we're facing this new set of challenges, which is the tariffs. And we're facing it in an environment where people are still, very stung by the big jump up in the price level we've seen. So, we've had plenty of coverage about the price of eggs over the last, year, 2 years, even the last few weeks. But that's just something that's fresh in everybody's mind right now. And so to be in an environment where expectations had increased so much over the last couple of years, and, we're now facing another threat where tariffs are sort of on the horizon, have been implemented on China. It's a different situation than what we experienced after COVID, which was expectations really broadly were very, very well anchored. And it took quite a while before they started to drift higher. Now, I think we don't really have that buffer any longer. It's fresh in everybody's mind, and we've got a new round of price increases coming. The data to start the year has been a little bit hotter than expected as well. So it's a more precarious situation, I think, in terms of expectations today than where we found ourselves at the start of COVID.
Yeah, good point about the mindset. Everyone's looking for inflation, so they're apt to jump on it the minute that they see it. You mentioned that we've seen hotter than expected inflation so far this year. You say it does not reflect tariffs. And instead, it reflects things like used car sales, medical care, apparel. Are these all idiosyncratic one-off reasons, or is there some larger narrative at play that we're not really bringing to light?
Yeah, so I think it's really, really hard to pin it on tariffs so far. January in particular, to me, was a very, very idiosyncratic issue, especially in the CPI, related to some technical issues with seasonal adjustment for used cars. So Chair Powell, you remember a few days ago, pointed to core goods, and he said, look, they started the year pretty hot. But when you look at core goods, excluding used cars in January, they were zero. They're basically where they have been prior to COVID, where they have been for much of the past year. So really, to me, January was pretty idiosyncratic. Some of core goods, again, excluding used cars in Feb, was only up a tenth. So we really haven't seen much of a jump there. My concern, though, is we are going to see it coming in core goods. I think probably most likely starting with that April report for the CPI, which comes out in the middle of May. Because we've seen a number of companies say, hey, look, we're getting hit by tariffs and we will raise prices. Very specifically, if you think about, home decor, furnishings, kitchen supplies, that is the area where we import a lot of stuff in general, but specifically from China.
Right.
And so a number of companies have come out and said, we're raising prices 5% to 15% beginning on April 1 or April 2. That will likely make its way into the CPI in that report.
Okay, so look for household furnishings to show pickup in prices. That'll be goods inflation. What is stickier in general, Omair? Is it goods inflation or services inflation?
Well, it tends to be services inflation because historically that's been much more driven, number one, by housing. And that is, the way that it's measured, as everyone knows at this point, is pretty lagged. And so that tends to shift very, very slowly. But even if you look at, for example, the super core, so core services excluding that housing component, typically that tends to be a bit stickier because you've got features like wages driving that. And that tends to be sort of more sustained effect on inflation. Whereas goods inflation, whether it's a supply chain issue, whether it's a temporary demand spike, that can sort of reset itself much more quickly. And right now we are talking much more about goods inflation when we talk about tariffs, but let's wait to see how much this really broadens out in terms of the tariff effect, because ultimately, let's say if we start putting tariffs on imports from Mexico, now you're talking about a lot of fruits, vegetable, food prices going up. That'll spill over into things like restaurant prices as well. And so that could impact sort of these secondary effects on services as well. So I think it's just a much different situation today. We're hitting more in terms of consumer goods than we did in 2018, 2019. And I don't think you want to think about that as a playbook for how tariffs will play out in terms of the inflation data this time around, versus what happened several years ago.
I am curious, though, Omair, about this idea of some of the structural changes going on in the global economy, if you will, and the relationship between nations, and how that maybe either affects or at least whatever sort of interplay there is with regards to prices and price levels. If we do see a meaningful shift in trading partners or the level of trading amongst countries here, does that have a long-term impact? And more importantly, is that a sticky long-term impact? Meaning, should we just learn to live with that?
Yeah, look, I mean, I think we've seen some of that begin already. And I think the White House has sort of said, look, there are companies, foreign companies that are making investments in the U.S. today. So a good example is Hyundai. They had planned to build a new Honda Civics in Mexico. They've decided to ship that production into the U.S. So that'll be good for, the area in which they're going to be building that new plant in terms of construction and manufacturing. It'll be good for the jobs that are created in that sector. But at the same time, those cars being built in Indiana are going to be probably more expensive Honda Civics than if they were coming from Mexico.
Right.
So that is going to cause those prices to move higher. So ultimately, the question is, how much is it sort of costing the consumer to bring this manufacturing into the U.S. or bring these jobs into the U.S.? We can go back to an example with the washing machine tariffs in 2018. We saw that a new plant went up. I think it was in North or South Carolina. Created about 1,500, 2,000 new jobs, but the estimates were at a cost of over $800,000 per job to the consumer. So there is a welfare loss to the consumer as well that you sort of have to take into effect. That kind of offsets, the increase you see in jobs and investment.
Yeah, and the welfare loss is something that may not be quantifiable in the same way. Omair Sharif, founder and president of Inflation Insights, thank you so much for joining us today. Coming up on the close, we've got U.S. bank stocks ending their 8-day winning streak. We're going to take a deeper dive into that sector next with Gerard Cassidy of RBC. This is The Close on Bloomberg. The KBW Bank Index ended its 8-day rally, which was the longest winning streak since 2016. So the question now is this just a pause or something more? Gerard Cassidy, head of U.S. Bank Equity Strategy over at RBC Capital Markets, joins us right now. And Gerard, I guess I'll start with this idea of how much of that 8-day rally was really driven by fundamentals versus simply a reallocation out of big tech.
I think it was more of a reallocation, Scarlett, because the fundamentals really haven't changed that materially over the last, 9 to 10 days. And you might remember coming into the year, following 2024, when the bank stocks outperformed the S&P 500 by a fairly wide margin. Coming into the year from January 1st through the end of February, the banks were up around 12 or 13% versus the S&P being up around 4%. And then we got into March and we heard the uncertainty on the public policy on tariffs coming out of Washington, and the stocks sold off. And I think it was really repositioning by a number of investors, particularly the hedge funds, de-risking their portfolios that caused the sell-off. And now we've got this rebound that you pointed to, though the banks ended down today. But the outlook for the banks, although it's a little more cautious, we understand that, particularly on loan growth, but the outlook still looks pretty good for the U.S. banks.
I'm curious what the bull case is. I mean, we were talking earlier here, there was some great data out of the New York comptroller about bonus season on Wall Street. That was up significantly on a year-over-year basis. In fact, I think it was like the strongest year they've had for bonuses since basically prior just to before the pandemic. What's going to drive the earnings going forward? We're going to get their new earnings, I think, in maybe 3 or 4 weeks from some of these banks here. Is it going to be trading revenue? Is it going to be deal making? Where's the growth?
It's going to be interesting, Romaine, because Jefferies, right before you and I started talking, released their first quarter results. They're on a different calendar or fiscal quarter than the traditional banks. Theirs is December, January, and February. And in looking at those results, equity trading was quite strong on a year-over-year basis, as was DCM advisory revenues, but what was really weak was FICC trading and ECM. So for the capital market banks, JPMorgan, obviously Goldman, Morgan Stanley, and others, we expect to see the investment banking revenues on a year-over-year basis being down for most of those banks, maybe 5 to 6%. And then on the trading revenues led by equity trading, because of the volatility we saw August or in March, we expect to see revenues up in trading anywhere from 5 to 10%. But we've got to remember the commercial banks, the real driver to revenue growth is net interest income.
Yeah.
And what's really going to be interesting, it's been 20 years since we've had a Fed funds rate over 3% with a positive slope to the curve. Now, the curve has come down a bit. We get that. But if we could get the Fed funds rate to 3 3/4, 4%, at 4.5%, 10-year, that is very positive for banks.
All right, Gerard, got to leave it there. Gerard Cassidy, head of U.S. Bank Equity Strategy at RBC Capital Markets. And we should point out those earnings from Jefferies are out. The shares are down. And as he said, investment banking revenues down, capital markets revenue down, asset management revenues down. So maybe this does become a trading story when we get to those financial earnings for the rest of the cohort in just about 3.5 weeks. When we come back, a focus on the pet economy. Petco just reported results. Chewy reported before the bell. And both companies, believe it or not, looking pretty good. A conversation up ahead with the CFO of Rover, the dog walking service. Charlie Wickers is going to be joining us in just a second, right here on The Close on Bloomberg. All right, welcome back to The Close. Earlier this morning, we got earnings out of Chewy. That, of course, is the big pet retailer. We just got earnings out of Petco after the bell. They were actually pretty good as well. Those shares up about 12% in after hours trading here. And it raises a whole lot of questions here about the so-called pet economy, if you will, here. An interesting report out by the folks over at Rover about how much people like me and Scarlett, both dog owners, are actually willing, or maybe we have to spend on our pets. Pleased to say joining us right now is the Chief Financial Officer over at Rover, Charlie Wickers. All right, Charlie, Scarlett and I, we're joking about this during the commercial break. We're both dog owners, and in full disclosure, I am a prolific customer on Rover as we get our dog walked every day. Talk to me about some of the numbers, though, because, I mean, you know, not to criticize, but I feel like the cost kind of keeps going up, and I'm a little worried.
Yeah, well, first, thank you for being a customer of Rover. We've been around for 15 years, and I love hearing that. It is true. Cost of pet ownership continues to go up. We put out, I believe it was last week, our annual cost of pet ownership report. And the numbers are the same in terms of the trends. They go up year after year. For the cost of pet ownership for a dog, we see it up about 7% year over year. For a cat, we see it up about 10%. And for the total cost of ownership of a pet over its lifetime, we're seeing it about $35,000. So we do continue to see those costs going up. And it's a trend, like I said, we've been around for about 15 years, and it has just continued to happen year after year.
There is, in your data, you kind of talk about this idea that some of the folks you surveyed, about at least half of them are concerned about the rising costs, they're concerned about tariffs, maybe even raising those costs further. But we were talking earlier in this program with an analyst about Chewy, and just the idea that pet spending for most people isn't really an option. It's not discretionary. You're going to do it, not just because you love your pet, but let's face it, you can't really explain to your dog why they can't have a treat or why they can't have certain things here. So I do wonder about the stickiness, the idea that even if costs go up, people are still going to use these services, whether it's your service or others, simply because they have to.
You know, that is what we see. We see that as time goes on, people continue to treat their pets more and more as kids. And for those who have kids, know that you don't trade off the needs of your kids for your discretionary needs. You trade down on your discretionary needs. And we're seeing that with pet ownership. In fact, we see something like 25% or about a quarter of individuals are willing to do some trade down in terms of higher cost foods down to lower cost foods to maintain their pet's health and happiness. But about a third are willing to trade down their own personal discretionary spends in order to make sure that their pet needs are met. And they're doing this consistently. And it's been a long tailwind that continues to play out in the pet industry. And I think Chewy's seeing it. I think Petco is seeing it, and we're continuing to see it ourselves.
What's interesting about pet ownership, too, Charlie, is at least in this country, it's certainly not limited to any particular income bracket. It is across the board. So I'm curious when it comes to people's spending habits on services for their pets. How has that shifted during this uncertain economic time?
It's shifted a little bit. We still see demand. We're still growing as a company, but we do see individuals changing their behavior just a little bit. So instead of maybe booking a 2 or 3 night getaway and having somebody watch their pet for 2 or 3 nights, especially in the instance of a cat, they might book a drop-in service instead and have somebody come by once or twice versus the actual boarding of their cat for those couple of nights. And so we're finding that individuals are finding solutions that work for them, their family, their budget, et cetera, but they're not trading off the needs of their pet at all. They're still very much concerned about their well-being, the love that they have for that pet, and how they take care of it.
Right. That makes sense. They're just kind of changing what they can based on what the availability of services are. We also know the labor market overall is softening. It's still healthy, but it is softening here and there. So I'm curious what that means in terms of supply of labor, people who are, raising their hands and putting themselves up as potential dog walkers or hosts for pets overnight stays.
Yeah, so we're operating in the U.S., Canada, and Europe, and the trends are the same across the board, all of those geographies. We continue to see people joining Rover to provide pet care services, whether or not it's for additional supplemental income or because they want the love of a pet in their life. In both cases, we do see people joining. They typically get a first booking within the first 3 months on the platform if they're active and keeping an updated profile. And then they go on to be rather successful sitters with us. Some are making about 4 figures a year, some even more than that. It's always fun to see the articles come out or the stories come out from our pet care provider saying it helped them afford a vacation that they wouldn't have had otherwise, or it helps them cover a debt that they were struggling to pay down. Those kinds of things are great to see, and we're glad that Rover exists and allows those pet care providers to make that side income.
Yeah, well said. I am curious about something else that I also saw in the data you put out, and this was about the idea that about 21% of the people you surveyed had their pets written into their will.
It is true, and personally, I'm guilty as well. My pet is written into my will. Okay. My wife and I have had this conversation, and we have a 2-year-old daughter. We have a 6-year-old golden doodle, and as much as we want to make sure our daughter is taken care of, we also want to make sure that our pet is set up for success. So we've identified an individual, a loved one in our lives that we know will take great care of Gus, and we've made sure we've set enough funds aside to help take care of his life expenses. This is something that is important to people, just like they're passionate about their children, they're passionate about their pets. Well, this is a trend that is continuing.
I feel like a bad pet owner. It never even occurred to me to put my dog in.
There's time still for you to go amend, your will.
There would. If I was a better man, I would.
Romain's going to think on that. But let me end on this, Charlie. When it comes to the change in pet ownership, not just in the U.S., but across the world, we've really seen a sea change since the pandemic. I mean, all these people entered the universe of pet parenthood during the pandemic. What's been the number one change that you've observed since then? I mean, because we're off the post-pandemic surge and things have kind of normalized. People are returning to the office. But what have you seen that still surprises you about the change in this country's pet ownership?
Yeah, I think the first thing is to step way back. If you think about pet ownership since 2011, it's been growing at about a 2% annual compounded growth rate, which is pretty impressive. But in terms of the number one thing that I see is that individuals are getting a second pet or a third pet. That was something I did not expect, but it is a trend that started during COVID and we've continued to see even to this day.
So you got to write in not just your first pet, but your second pet and your third pet in your will as well.
Scarlett,
yeah, it is. All right, Charlie Wickers, CFO of Rover, thank you so much for joining us. Really interesting conversation there. Pet parenthood, Romain, it cannot be a discretionary purchase. It's a staple.
Do you rely on dog walkers or
things
like that?
Yeah, no, my dog walker, I treat her as well as I can.
Yeah, I am curious. That was a good question about the people who work on the platform because we actually live near a major university, so you get a lot of college kids, grad students who do this to make some extra income. And you know what they charge on an hourly basis.
How much are you paying?
I don't want to tell you, but I think about quitting this job sometime and just walking dogs for a living.
We're going to see Romain in Upper Manhattan walking 4 dogs at a time. All right, let's take a look at how markets closed on the day. It was a down day for equities there. 1.2% loss, 1.1% loss, but most of that was because of a big sell-off in Mag 7 names, whether it's NVIDIA, whether it's Tesla. The equal weight index the loss was much, much more modest. You're looking also at the 10-year yield moving up by almost almost 4 basis points. And everyone's still waiting for some kind of announcement on auto tariffs.
Yeah, it was kind of interesting to see the volatility that we saw in auto stocks. As a group, they were lower, but it was kind of, everyone was trying to figure out what type of exemptions might exist. So you kind of saw some of the automakers fall, some rose, some of the auto parts makers fell, some rose, and I don't know, Scarlett. I mean, we'll see what happens when the president speaks, hopefully in a few minutes.
People are trying to make sense or get ahead of it best they can. This is The Close on Bloomberg. All right, this is The Close, and we are awaiting President Trump's announcement on tariffs for the auto industry today from the Oval Office. When that happens, we will take you there live. In the meantime, let's bring in Bloomberg's Detroit Bureau Chief David Welch to give us a sense of what we can expect. So this announcement was supposed to come at 4 p.m. They're running a bit behind here, but what do we think, based on our reporting, the president will say?
So far, what we think it will be is tariffs on finished vehicles, not the parts, and probably Canada and Mexico, but we don't know what other countries. You know, he's talked about China, Korea, all of that could be in the mix here. And, there could be a China angle to this too. This is all speculation at this point, but Trump could do something to make sure Mexico isn't a backdoor for Chinese vehicles to be imported into the U.S. using USMCA. There could also be exemptions for USMCA vehicles, which would be some breathing relief for Mexico and Canada, because that would leave the USMCA benefits still intact. So these are the kind of things we're looking at and looking for, and we'll see what else Trump has when he finally does have his press conference in the Oval Office.
It's kind of interesting, too. I mean, they talked about, at least in the Bloomberg reporting, this idea that this would most likely be on the actual finished product, so the finished car here. Just give our viewers some context, David, about whether the types of cars that are actually assembled here in the U.S., so the ones that effectively wouldn't be affected by this, and those that are assembled outside of our borders.
Yeah, look, it's kind of across the board. So you look at, you would think it's the smaller, cheaper vehicles that they would build in Mexico to get cheaper wages, but it's not just that. You do have something like cheaper vehicles like a Chevy Equinox. That's kind of their small, compact crossover SUV. But they also have pickup trucks made there. General Motors and Stellantis both make them there. GM also makes pickup trucks in Canada. Those are expensive, profitable vehicles, but they would come across the border with tariffs if that's what Trump decides to do with those two countries. GM does have some cheap vehicles made in Korea. They have a hot seller, the Chevy Trax. It's one of their best-selling vehicles now. It's about $22,000. It's a very affordable vehicle for a lot of Americans who want a new car. If there's a tariff on South Korean vehicles, then that would be subject to it and make that vehicle more expensive. I think it is a bit of a relief if it comes to pass that it's not parts, because you start putting tariffs on parts that would raise the cost to build and maybe the price on every vehicle made in the U.S., because they all get parts from Canada and Mexico and other countries. It's just the supply chains are that dispersed.
Right. So the Trump administration has made clear that they're willing to endure short-term pain or disruption for long-term benefits of this attempt to force companies to bring production into the U.S. or back to the U.S. What have we seen, David, in terms of companies, automakers, auto parts companies, bring back some of that production? Are we starting to see any of it?
We didn't see a lot of it in Trump's first administration when he made some adjustments to NAFTA and turned it into what is now USMCA. You did see the other day a $21 billion investment announced by Hyundai. I think some of that may have been in the works already, but, I would say bigger picture, manufacturing companies are looking at the idea that we do get tariffs on steel and aluminum every so often, either from the U.S. or others, and the world's getting bigger again. So, it's not just the U.S. that's adding tariffs. You're just seeing trade get a little less free and a little more expensive. So companies are kind of slowly, gradually moving more production to where they sell, because it's the whole free trade regime in the world is becoming less predictable, and you're seeing more tariffs. Yeah. And so the only way to get predictability is just build where you sell.
All right, David Welch, our man, they're out there in the Detroit bureau as we await those comments from the president on what those auto tariffs are going to look like. Jennifer Flitton joins us right now. She's down in D.C., head of U.S. government affairs over at Invesco. And I just want to point out real quick to our viewers, great story on the Bloomberg terminal about how Canada and India have been holding significant talks here to try to circumvent some of the trade issues with the U.S. We're also learning that the Mexico's economy minister is now in Washington and is set to meet with Howard Lutnick on some of these trade issues. And Jen, I want to get your general thoughts here on the policy approach, not necessarily coming from Trump, but what his cabinet members and aides are doing right now with regards to talking to some of these other nations, whether it's about exemptions or any sort of, concessions maybe they can make to get Trump to back down. Is there anything out there?
Yeah, that's right. I think we saw Secretary Bessent in interviews and reporting about a week ago talk about some of these pre-negotiations. The conversations, the lines of communication are clearly open with the Commerce Secretary, with the USTR rep, Jamieson Greer. Those conversations are clearly happening. And I think the question that we have right now with this announcement of additional auto tariffs is whether the president is escalating things in a way to really create a leverage point going into further negotiations when that Liberation Day on April 2nd comes to pass.
Well, I'm glad you brought up Liberation Day. That is a week from today, April 2nd, next Wednesday. But the president's already kind of teased some things. I mean, maybe copper might come before that, copper tariffs. I am curious as to how much weight we can put on that April 2nd day, because a lot of us right now had that X'd out in our calendar, and some have a feeling that by the time we get to April 2nd, it might be moot.
Yeah, and we're whipsawed, right? I mean, we had some earlier reports this week that sectoral tariffs weren't going to be the focus of this April 2nd report, but then you saw interviews with the president that seemed to indicate that he was open, especially on auto tariffs. So, yeah, I think the uncertainty continues.
The uncertainty continues, and it's not just tariffs on specific imports that come into the United States. President Trump this week also appeared to invent a new strategy of these secondary tariffs on countries that buy oil from Venezuela and trying to discourage that from happening. Can you walk us through how that may be applicable to other products and how we might start to see that fan out?
Yeah, I think he is very focused on not only the ways in which we receive oil and the larger energy market, quite frankly. And we're seeing some of this on reconciliation, a real focus on U.S. energy production. But he's also looking at ways, and I think David said this in this earlier segment, of ways in which other countries are sort of entering our market through Mexico, through Canada, and really a focus on that. And we may see some of that sort of telegraphed in his announcement on autos here shortly.
And Jen, as you look ahead, so far we've talked about tariffs, or the president has talked about tariffs on steel and aluminum. We're announcing something on autos any minute now. Copper is something that's in the works and perhaps could happen sooner, in a matter of weeks rather than a matter of months, as Bloomberg has reported. What is the next sector or industry that you would look for tariffs to be a big focal point for?
I think I'm really focused on these reciprocal tariffs, right, and how they're going to calculate. And I think Secretary Bessent stated it rather simply as putting a number on the dirty 15, as he called them. How is that then going to initiate implemented tariffs, sort of the action on tariffs right away, but then how is that going to affect negotiations going forward? That's what I'm really focused on, are some of the U.S.'s biggest trading partners and some of those trade imbalances. And we know that's the perspective that this president sort of views trade, is in those deficits and surpluses. So that's really what I'm focused big picture right now.
Absolutely. I do just want to get your thoughts before we let you go here about that Congressional Budget Office report here that basically says that the default risk for the U.S. now back in play once again here. They're putting that deadline, I put that in quotation marks, as August. We know how soft and fluid that can be here. What is the state of the budget process right now on Capitol Hill?
Right. So we had some news this week. Majority Leader Thune in the Senate and Speaker Johnson and the tax rating committee heads went to the White House. They had the conversations about reconciliation and getting that budget resolution done in this work period, which we're the first week of a 3-week work period. And so the plan is to have a budget resolution with reconciliation instructions and include the debt ceiling language in this budget resolution, and do it before the recess here, right before Passover, Easter, so that they can kick off immediately when they come back after the recess.
All right. Thank you for sharing that timeline that we can look ahead to. Jen Flitton is head of U.S. Government Affairs at Invesco. Thank you so much. All right. Time now for the top 3, where we name drop the people driving some of the day's most talked about stories. And first up is Apple CEO Tim Cook, or Tim Apple, meeting with who he calls the new generation of developers in DeepSeek's hometown of Hangzhou, China. Today, he was visiting the city's elite Zhejiang University, where Apple donated $4.1 million. Not clear, Romain, however, if he visited any of the companies during this trip to Hangzhou.
Yeah, not clear. But I just do want to point out, can you just give this guy a little golf clap? The way he's navigated geopolitics over the last few years has really been astonishing. I mean, how many CEOs, American CEOs right now, would you see sitting in a chair like that? That's a good point. Without any sort of reservation? I'm keeping an eye on George Clooney. He's in a new play on Broadway.
Yes,
Good night, good luck here. It had the biggest opening weekend for a Broadway show of all time, $3.3 million, breaking a box office record that was just set the other week by Othello for $2.5 million. And it was raising a lot of questions here about the star power that these George Clooney, Denzel Washington bring to Broadway in terms of getting people to actually buy tickets, but also whether they're kind of maybe making things a little unaffordable for people who actually want to go see the show.
Broadway was always kind of unaffordable for most people. Let's face it. But yeah, I think it's a good point that a lot of these big stars are moving to Broadway for that experience, that once in a lifetime thing, as opposed to on streaming or network television. Which are they still coming out with new shows? I'm not even sure. But in any case, there's an overload of supply there.
Television.
All right. Last up here is Dr. Simi, the beloved mascot of Mexican drugstore chain Farmacias Similares. Pop music fans have been throwing plush Dr. Simis onto stages around the world to make clear that they're from Mexico. And now the company is expanding into the U.S. market on the back of his popularity.
Is this going to dilute the brand? First of all, I mean, what are the tariffs going to be on this thing? Is that does Trump know about this?
It's a good question.
But no, this is a sweet story. I love this. Someone who's traveled to Mexico a lot. I was kind of surprised to see that this has now become a big sort of international thing. Yes.
Yeah.
Yeah.
Did you pick one up?
I did not. I didn't think anything of it. I was just like,
now it's a collector's item.
There you go. I know I should have bought it. Who knows? Foresight, Scarlet Fu. Those are our top 3 when we come back. What to watch tomorrow. This is Bloomberg. Economic concerns drove part of the market today, and that could drive it tomorrow as well. We get some economic data tomorrow morning.
Yeah, jobless claims, also the third reading of fourth quarter GDP, which is ancient history right now.
Yeah, ancient history, but more recent history. At 10 a.m., we are going to get pending home sales. That could be interesting.
That could, because the recovery has been kind of slow here.
We're also going to get some additional earnings. Earnings season never stops. Scarlett, a read on consumer spending.
Yeah, Lululemon, discretionary for most people, but for some people, I'm sure it's a staple.
Normally, I don't like Fed speak. Well, we got a lot today, and it was actually significant. We get more tomorrow.
Yeah, Barkin and Collins will be speaking. We'll give you the details.
And another update from the Congressional Budget Office, a big focus on Washington, a big focus on the markets. Tune in tomorrow for Scarlett and I right here on The Close for all your Washington news, and as well as that Trump press conference. Stick around for Balance of Power.